Hey, savvy investors! Welcome back to Investing Lighthouse, where we break down complex financial concepts into digestible nuggets of wisdom. You know, the kind of wisdom that bulks up your wallet while slimming down your worries. Today, we're diving headfirst into the rich, timeless wisdom contained within the pages of a Wall Street classic, The Intelligent Investor by Benjamin Graham. Before we go on, let's hear it from the masters. None other than Warren Buffett, the Oracle of Omaha, referred to this gem as the stock market Bible, and as, by far, the best book on investing ever written. And if you didn't already know, Warren Buffett is a former student of Graham, and one of the most successful investors of all time. Bill Ackman, the well-known hedge fund manager, praised Graham's book as the best resource for understanding the basic principles of value investing. John Bogle, the founder of Vanguard Group, described The Intelligent Investor as the book that changed my life. Joel Greenblatt, a successful hedge fund manager and professor at Columbia Business School, has claimed it is the best book ever written on investing. Talk about rave reviews. Alright folks, if you're as excited as I am about unearthing these nuggets of wisdom, give us a thumbs up and let's get started. First and foremost, Graham notably distinguishes between investing and speculating. An investor perceives a stock as an integral part of a business, meticulously evaluates its fundamentals, and makes investment decisions based on its long-term value. A speculator, on the other hand, buys and sells based on market trends and seeks to profit from short-term price fluctuations. For example, let's say you buy shares of a tech startup purely because everyone else is doing so, without understanding its business model or financial health. That's speculation. Graham emphasizes the importance of being an investor, not a speculator. Think of it like this. Investing is like a dedicated farmer tending to his crops, while speculation is a treasure hunter looking for instant gratification. The investor sees value. The speculator sees price. The investor is patient. The speculator wants immediate results. Which one are you? Remember folks, the stock market is not a casino. And if you treat it as such, you're playing a losing game. Or should I say, you're betting on it. Takeaway number 2 revolves around a simple yet profound principle: the margin of safety. This is the difference between a company's intrinsic value, its real worth, and its market price. By ensuring a margin of safety, investors can minimize their downside risk. Let me put it this way. Imagine you're buying a pair of designer sneakers. The store price is $200, but you know that at the factory outlet, the same pair goes for $120. So the intrinsic value is $120, but the market price is $200. That's a negative margin of safety right there. But hey, if you could get those sneakers for $80, now you're shopping with a margin of safety. It's a simple principle, but it's the crux of value investing. The third takeaway introduces us to a character Graham called Mr. Market, the manic depressive business partner who swings wildly between irrational exuberance and unwarranted pessimism. One day, he's euphoric, offering you high prices for your shares. The next day, he's despondent, willing to sell you his shares for a pittance. If Mr. Market was a weather app, you'd delete it instantly. Graham suggests not to be swayed by Mr. Market's moods, but should use his mood swings to our advantage, buying when he's pessimistic and selling when he's overly optimistic. Don't let Mr. Market's daily fluctuations influence your long-term strategy. Next, Graham presents us with two types of investors: the defensive and the enterprising. The defensive investor seeks safety and freedom from bother. They want to avoid significant errors and secure a reasonable return, but don't have the interest or time to become expert investors. Graham's advice: diversify your portfolio. Lean towards high-quality bonds and blue-chip stocks. And stick to a steady and disciplined investment plan. The enterprising investor, on the other hand, is willing to dedicate time and effort to finding undervalued stocks. This person is like your college friend who spends hours researching companies and market trends. Graham recommends buying companies at a discount to their net current asset value. This approach, he believed, would provide a margin of safety and potentially higher returns. Now, there's no right or wrong type here, but knowing which one you are can help you create an investment strategy that suits your personality and lifestyle. Moving on to the fifth takeaway, diversification. I know, you've heard this one a million times, but let's look at it from a different angle. Picture your investment portfolio as a box of chocolates. You know, like in Forrest Gump, you want a mix of caramel-filled, nutty, fruity, and dark chocolates to cater to your varying taste buds. Similarly, a well-diversified portfolio gives you a broad flavor of the market and protects you against the unforeseen. Remember folks, don't put all your eggs, or in our case, all your chocolates in one basket. Now the sixth wisdom nugget from Graham's treasure chest. Invest in what you understand. Would you consider purchasing a car without having any knowledge about its features or performance? Unlikely. Then why do you do it with your investments? Don't chase the latest hot stock that everyone is buzzing about unless you've done your homework and understand the business. Be an informed investor, not a blind follower. Before we move to the bonus takeaway, here's an interesting bit of trivia. Did you know that Warren Buffett was once asked to collaborate on a new edition of The Intelligent Investor? However, there was a significant divergence of views between him and his mentor. Graham was a staunch advocate of diversification, but Buffett leaned more towards concentration, believing in the philosophy of putting your eggs in one basket and watching that basket closely. Buffett has long been known to favor a focused portfolio, once saying, "Diversification is protection against ignorance." It makes little sense if you know what you're doing. On the other hand, Graham's approach leans towards broad diversification. It's like Buffett preferring a couple of gourmet chocolates, while Graham would opt for the entire assortment. This difference in views is why Buffett didn't contribute to the revised edition of the book. And now, the moment you've eagerly anticipated, the bonus key takeaway, emotional discipline. Graham emphasizes the importance of controlling one's emotions when investing. Imagine you're watching your favorite sports team, and they're losing. You don't sell off your fan merchandise mid-game, do you? Then why panic sell stocks when the market is down? Maintaining emotional discipline amid market volatility separates great investors from the rest. While these principles might seem simple, the key lies in understanding, applying, and sticking to them through thick and thin. That's what sets apart the truly intelligent investor. Remember, investing isn't about getting rich quickly. It's a marathon, not a sprint. And the lessons from Benjamin Graham's book are the hydration stations that will keep you moving forward on this long journey. We've covered a lot today, folks, but as always, it's not just about listening. It's about taking action. So here's my challenge to you today. Choose one of these principles and begin implementing it into your investment strategy. So there you have it, folks, the pearls of wisdom from Benjamin Graham's The Intelligent Investor. Time-tested principles that have shaped generations of successful investors. Which of these resonated with you the most? Or do you have another nugget to share from your reading of the book? Let us know in the comments below. Don't forget to hit the subscribe button if you haven't already. And give this video a thumbs up if you found it helpful. Remember, the more you learn, the more you earn. Until next time, stay curious, stay invested, and stay savvy, folks.